If you're like most traders, you've probably felt overwhelmed by the complexity of Forex trading. There are indicators everywhere, hundreds of strategies, people on YouTube and other social media telling you 10 different things at once. It's no wonder most people struggle to even know where to start, let alone be profitable in trading. I've been there too. I'd spend hours analyzing, flipping between different indicators, hopping from one strategy to the next, and honestly, it felt like I was working harder than the market itself. I would wonder if it was actually worth it, going through all of this learning trial and error, just trying to make some extra cash for me and my family, and thought of quitting so many times. Sometimes I'd get stuck in what's called analysis paralysis, staring at the chart for hours but too scared to actually place a trade. Other times, I'd do the complete opposite. Jump into a trade impulsively, only to have second thoughts just minutes later. The truth is, the hardest part of trading isn't necessarily the strategy. It's keeping your emotions in check and finding a system you can stick to, which is simple and repeatable. Most traders either bounce between different approaches without giving any of them time to work. They don't understand that losing is part of trading, and going through losing streaks are also part of the game. They also get so caught up in the noise, news headlines, social media chatter, endless analysis, that they never actually build confidence in their own trading plan. This is how big institutions thrive, throwing you multiple social media postings, which are mostly automated by bots, by the way, guiding you into the direction that they want so they can trigger your stop losses, grab that liquidity, and then send the price sky high to where they want. That's why today, I want to strip it all back to something simple. I'm going to share with you 2 strategies that I personally use. They're straightforward, they don't require you to stare at charts all day, and most importantly, they give you structure so you're not just gambling every time you hit that buy or sell button. The first approach is a grid trading strategy combined with dollar cost averaging using the 200 simple moving average on the 15-minute chart, or sometimes the 1-hour chart. The second approach is a support and resistance strategy on higher timeframes, the 4-hour or sometimes the daily chart. These 2 strategies complement each other really well. One is designed for shorter-term moves where price snaps back to balance, and the other is for those bigger, stronger levels where institutions tend to leave their footprints. Let's start with the grid and DCA strategy. So here's the idea. If you've traded Forex for any length of time, you'll know that price tends to revert back to its average. And that's where the 200 moving average comes in. On the 15-minute chart, if price moves too far above or below that line, it's often only a matter of time before it comes back to retest it. That's the basis for this strategy. If you see here, the Euro-US dollar has spiked 100 pips above its 200 SMA on the 15-minute time frame. Instead of chasing the move, what I'll do is place a small short position, expecting that price will eventually drift back toward the SMA. Now, sometimes price keeps climbing further away, and that's where the dollar cost averaging part comes in. If it goes, say, 50 pips further, I'll add a second small position. The key word here is small. I don't throw my entire account at one entry. My lot sizes are usually 0.01 or 0.02, tiny positions compared to my balance. Why? Because in grid trading, survival is everything. You're not aiming to nail the exact top or bottom. You're building a position so that when the market does revert, those small trades combined add up to a nice profit. Now, here's why it works. Markets, especially in Forex, tend to snap back to their average. You'll notice over and over again that after an aggressive move in one direction, the price wants to test that moving average again. Think of it like a magnet. Price might swing away, but eventually it gets pulled back. Just like in this case. The price spiked up by about 100 pips, but the following day, price moved back to the moving average, giving us a 73 pip profit. Now, why is it not 100 pip profit, since we took a short at 100 pips away? Well, while the price was slowly coming down, the moving average was slowly moving up, accounting for the price's previous move up. So when the price came back to the moving average, the pip move was 73. Still a great profit, considering it only took a day to play out. Of course, there are risks. The biggest mistake traders make with grid strategies is over-leveraging. They keep adding and adding larger positions, and before they know it, one extended trend wipes them out. That's why I stick with tiny lot sizes, no matter how tempting it is to increase them. And yes, sometimes the market trends for longer than expected, and you have to be patient. But with discipline, this strategy gives you a structured way to trade those snapbacks without relying on guessing tops or bottoms. So basically, you're buying when the price is below the moving average and selling when the price is above the moving average. That's typically the opposite of what normal retail traders do. But if you think about it, that's okay, since about 90% of retail traders lose money in trading anyway. Now let's move on to the second strategy, support and resistance trading on the higher timeframes. Support and resistance levels are some of the most reliable concepts in trading, and the reason is simple. They're levels that everyone sees. Retail traders, big institutions, algorithms. These zones are like battlegrounds, where the market decides whether to keep pushing or reverse. If you look at the various approaches you can take to enter a trade, you'll notice that most strategies in technical analysis are based around support and resistance levels in some way or another. So what I do is zoom out to the 4-hour or even the daily chart and mark the key support and resistance zones. These aren't random lines. I'm looking for areas where price has historically reversed multiple times. 2 to 3 touches is ideal. When a zone has been retested many times though, the probability of it eventually breaking gets stronger. Let's take an example. Suppose GBP US dollar is approaching a strong 4-hour support zone that's been respected several times in the past. When price comes into that area, I'll look for a buying opportunity. I don't complicate things with 10 different confirmations. I keep it simple. If it reaches my level, I enter. It's as simple as that, and simplicity means it's also easy to repeat. Now for risk management, I use a 1-to-1 risk to reward ratio, at least to start off with anyway. That means if I'm risking 50 pips, my target is also 50 pips. It's not flashy, but it's consistent. The beauty of this approach is that it gives me the freedom to cut the trade early if things don't look right. For example, if price hits the zone but starts moving sideways, or worse, starts pushing against me, I'll exit early. That way, I take a small loss instead of letting it grow. There are, of course, some times where I could get stopped out at my stop loss before I have a chance to exit early, even on higher timeframes, but that's rarely the case. Most of the times, if the trade does go against me, I will exit at halfway or 2/3 of the way before my stop loss is hit. And here's the flip side. If the trade goes in my favor, I'll sometimes hold it beyond my initial take profit, especially if the momentum is strong. The take profit could be changed to a 1 to 1.5 or even a 1 to 2 in some cases. That's where patience comes in. Some of my best trades have been the ones where I simply sat back and let price move, and to be honest, my greatest trades are the ones that I'm either asleep or doing something else apart from looking at the charts. The more you look at the charts, the more chance your brain will play tricks on you, and you will want to interfere with the trade. Now the reason why this strategy works is because higher timeframe zones carry more weight. On the 1-minute or 5-minute chart, support and resistance levels are being broken constantly. But on the 4-hour or daily, those levels represent where serious money is moving. And as retail traders, our best edge is to follow where the big players are likely to act, ignoring all the short-term noise. And like I said before, by using higher timeframes, you're able to exit the trade early if the price goes against you. Therefore, even though the risk-to-reward ratio is 1 to 1, if you're letting your take profit getting hit while you're cutting your loss short, and your win ratio is only 50%, then you're still in profit. And that's the edge you have with this strategy. So let's talk more about risk management and the psychology that needs to be applied for both strategies, because no strategy in the world will save you if you ignore these two things. For the grid DCA strategy, patience and discipline are key. The temptation will always be to increase your lot sizes so you speed up the profits. But remember, the reason most grid traders blow up their accounts is because they take on too much risk. When you calculate the dollar amount on your take profit target, I can guarantee you it will cross your mind that the dollar amount you will potentially win will look too small, so you will want to increase the lot size. Please don't. Keep it small, spread your entries, and trust the process. Taking small profits consistently is the way to go for this strategy. For support and resistance trading, the biggest challenge is patience. You'll find yourself waiting days sometimes for the price to reach your zone so you can enter a trade. That's normal. Don't force trades in between. If you enter too early, your risk management plan takes a big hit. Let me explain. If you were planning a short entry at this resistance zone, but you entered here instead of waiting a bit longer to get a better entry, as you planned all along, then notice how, with the same amount of pips, your stop-loss price decreases, making you more vulnerable to get stopped out, but also your take-profit target increases, making your trade less likely to be a success. Now, across both strategies, capital protection comes first. I personally split my funds across multiple accounts. That way, even if one account takes a hit, or in the case of DCA, if an account blows, I've already secured profits into my main account, or even withdrawn them into my bank. This takes away the fear, because I know my overall capital isn't at risk in one single place. I have separate accounts for my DCA strategy, and separate accounts for my support and resistance strategy. And towards the end of each month, I transfer the profits into other separate accounts, or into my bank account, which I then invest into crypto or stocks. Let me be clear, this is not financial advice and I am not a licensed financial advisor. I am just showing you how I trade. Any strategy you may use, whether it's the same as what I use or any different strategy, you need to do your own backtesting, preferably on a demo account first. Find a strategy that suits your character, and find the timeframes that best suit the available time you have to trade with. And of course, in time, find the amount that you, and you alone, are comfortable of trading with, having in mind that most traders lose money, and you might lose all your trading capital at some point. So let's wrap this up. We've covered two strategies today: the grid and dollar cost averaging method using the 200 SMA on the 15-minute chart, and the support and resistance method on the 4-hour and daily chart. Both are simple, structured, and designed to take the emotion out of trading. If you take anything away from this video, let it be this: trading doesn't have to be complicated. In fact, it's the opposite. The more simple your approach is, the more profitable and the more repeatable it becomes. Simplicity, discipline, and patience are what make the difference. Now, I'd love to hear from you. Which strategy are you more interested in trying first? The grid DCA approach, or the higher timeframe support and resistance zone strategy? Let me know in the comments below. And if you found this video useful, hit the like button, subscribe, and check out my other videos, where I dive even deeper into Forex strategies and psychology. Thanks for watching, stay safe, stay disciplined, and I'll see you in the next one.